Mark, welcome. Thank you for being here tonight.
Well, thank you. And thank you for being here. Thanks to everybody for being here. Welcome to the July session of the Roundtable. It's kind of we hope to keep this short and sweet for, short summertime session, but you never know where this stuff will go as we dig in a little bit deeper. Um, we're celebrating a birthday or an anniversary here tonight. We actually started this 5 years ago, and we've done this every single month since July 2010. So we might spend a little bit of time reflecting, but again, we want to keep this fairly short and sweet. But I am joined here tonight by my friends Ken Kavula, who's a nationally recognized investment education leader, gives presentations nationwide, and has done a whole number of things. Cy Lynch was supposed to be with us tonight. He's unable to join us. He's either saving souls or saving animals. I think this week it's he and his wife do a lot of stuff with charities for homeless animals and that kind of stuff, and I know they're off doing some of those type of things this week and were unable to join us. Hugh McManus joins us from Pasadena. Greetings, Mr. McManus. Hugh is just knocking it out of the park. When we look back over 5 years, he does tend to make some unconventional type selections, and I'll just do a little bit of a spoiler. A couple months ago, he selected a fairly unusual stock ticker ADRX. That's up 80% in the last couple of months. So again, we welcome that sort of thing because this really is about sharing actionable ideas. Now, some of the ideas are not going to be, consistent or suitable for your portfolio, and you just pass and go on to the next one. But we really are here trying to bring decent ideas and have that collective or composite over 5 years beat the market. That's what we talk about when as it shows here on the title slide, the quest for relative return. We want positive relative returns. We want to beat the market. I want to share those ideas, and we do keep score. We'll be covering that here in a few minutes, but over the last 5 years, we've actually done fairly well, and we see even better days ahead. So let's go ahead and get underway. Here is our standing agenda. This is the type of thing we do every month. Again, welcome to people that have been here many months over the last 5 years, and a special warm welcome if you're joining us for the first time. We do try to keep this fairly informal. There will be a question and answer session following the audience poll after we make our stock presentations, and we welcome your questions and any topics that you might be curious about. We will spend some time talking about results, the results of the transactions or decisions that we've made over the last several years. And then we'll go into three fairly quick presentations. Apple, ConocoPhillips, and Buffalo Wild Wings are on the agenda for tonight. And like it says there, we will have an audience poll when we're done. Here's our quick disclaimer. Again, everything we do here is intended to demonstrate and literally show the philosophies and the principles and methods of the modern investment club movement, how we look at stocks, that sort of thing. Everything we do here is for illustrative purposes only. Please do your own homework, and no investment recommendation is intended. But we will be talking about real stocks in real time, and all of that disclaimer applies. If you'd like to add yourself or yourself and a friend to the reminder list, you can write to nkavula1@comcast.net. That's Ken's better half, Natalie, nkavula1@comcast.net. And then if you do have questions that you need follow up on, you can also write to me, Mark R. @manifestinvesting.com. We've been having some fun over the last 5 years. This is just our quick reminder of what we're trying to do. And the three of us tonight will be bringing one of our single favorite investment opportunities at the current time. And we do welcome untraditional picks. Hugh usually handles that part of the portfolio for us from time to time with great success, I might add. But the real goal is to take that collective, the composite, and outperform the Wilshire 5000 or the general total stock market by 5 percentage points over the long term. We'd really like to see 3 out of every 5, perhaps even 4 out of every 5, actually work out such that our selections outperform the market after we pick them.
Mark, if I could interrupt you for a moment, we have a hand in the air, and I'm going to unmute Marianne. And Marianne, go ahead and ask your question.
Sorry, I punched the wrong button.
Okay, thank you so much.
Come back later.
Yep.
All right, here's a look at how things have gone since the early days. We had kind of a slow start out of the gate. I don't think that's terribly unusual. You know, sometimes some of those early positions can not work out so well, and I mean, I've seen clubs do the opposite of this. But again, over the long term, again, long termer is what matters. We've noticed that the relative return of our collective portfolio, the tracking portfolio, has actually trended up towards approximately 2% relative return. Now that's annualized. Let's define relative return. Basically, the relative return, by the way, Ken is covering this in his column for this month in our newsletter. The relative return is literally taking the actual return achieved by one of the stocks that we select and then comparing or contrasting that versus the Wilshire 5000. So you're literally mirroring or matching and comparing that performance. So if we beat the market, it would be a positive number. If the stock failed to beat the market, it would be a negative number. And again, this is a collective number of approximately 100 different stocks that have been picked, some of them multiple times. That 5% line that you see up across the top there, the dotted line, that is the objective. We'd like to get to that point for the collective of stocks chosen, and that's kind of the long-term philosophical target of investment clubs, to beat the market by 5 percentage points over the long term. So again, we're quite happy to be at 2%. We look forward to continuing to ascend, and many more picks like Hugh's from last month, and we've had some really good ones. Tevo was really kind to us here over the last couple of days, hanging in there pretty well. The outperformance accuracy, again, we'd like to see 60%. That number's actually up. It has been significantly lower. Now checks in at approximately 54%. Good to go with that, Ken, or is any other questions?
Yeah, it sounds real good. I'm real happy to see the accuracy beginning to inch itself up, because I think as that accuracy inches up towards 60, we'll see relative return begin to inch itself up maybe to 2.5%, 3%. I don't want to diminish what we're doing here. The statistical relevance of beating the market by even 2% is pretty impressive. When you consider what a 2% beat can do over a period of 20 or 30 years, I think you'd be very pleased with that little tiny plus to what the market normally gives you.
Yeah, and when we look back at the track records of many of the legends, you know, somebody like a John Neff of the Vanguard Windsor Fund, you know, over his lifetime, he thinks he achieved about a 2% relative return, and he had he did spectacular things for a nation of investors. So, I mean, that 2% is nothing to sneeze at. Again, we'd like to see 5%, but you know, 2% ain't bad over the long term either. Here's a look at the stocks that are kind of behind.
Yeah, it certainly isn't. I mean, 2% is a huge.
2% is huge.
No, I was just saying it's a huge deal, but the other thing I always stress to people is that while you can celebrate getting, you know, 2 or 3% or even 1% above the market, I don't know why more people aren't outraged when a 401k charges you 1.5 or 2% a year just for the privilege of holding your money in an account. So I'll get off my soapbox now.
Oh, that's a big deal. I mean, that I don't have the chart here, but many of you have seen it in the past. When we start flinging the long-term performance, speaking relative return for a bunch of institutional funds, you know, mutual funds and et cetera, you're very hard pressed to find a lot of them that are above zero. In fact, the vast majority of them, and many times it's due to the things Hugh was just mentioning, are down in that -2, -3% range on a relative return basis. And again, it's just...
Mark, we have Julie from Georgia making that exact same point, that a 2% beat of the market does beat most portfolio managers that are in it professionally.
Yeah, probably 95 to 98% if I had to just throw a rough number out there. So that's, again, thanks, Ken, for pointing out that 2% actually is pretty special. Well, here's the stocks that have among them that have contributed to that success. What you're looking at here are the most influential, the most commonly selected stocks over the last 5 years. By the way, you can look at the list of 100 or so, and that's a public link up at the top on dashboards/public/round-table. You can actually take a look at the full list of 100 stocks. These are the ones that are actually the largest contributors today. What we do every month is if one of us, either a knight or a guest damsel or an audience vote, selects a stock, we take and put $1,000 into it. So right up at the top of the chart, you see Cognizant Technology actually accounts for nearly $19,000. Well, Cognizant has actually been selected 12 times, probably 9 or 10 of those times by Cy Lynch. And it's worked out pretty well. Again, $12,000 has become $19,000. And as you go down that list, you can kind of decode a bunch of those. And there have been a number of multiple selections, but the number of repeat selections is shown in that legend up at the top. And the one that I would pick for tonight to kind of point out is Masimo down there at the bottom. Masimo has only been selected a couple of times. That's the non-invasive medical supply company, medical device company that I think has a really nice story, and it's shot up pretty significantly. That $2,000 invested in Masimo is now $4,000. Anything jump off the chart at either of you guys?
Yeah, Mark, I always like to look at ones that have been picked only 2 or 3 times off of this leader list right here. And you jump up to Maximus and you jump up to PRA Group. Both of them only picked 3 times. PRA Group is sitting, down maybe in the 9th or 10th position and only picked 3 times as compared to some of the other ones on the list that have been picked 6 or 7 times. So we're looking at some real spectacular performance in some of these picks.
And we should give a nod to a couple of the guest damsels that are here tonight. I know that Ann Manning is responsible for one of the PRA Group selections, and Kim is also here. By the way, the guest damsels do have positive relative returns for the selections that they've made over as when they appeared here in a guest appearance, and have really bolstered their performance pretty well.
Mark, we're getting a question from Laura, and she wants to know, are each of the 12 times that we've picked Cognizant, are they figured separately and then averaged together to get their total relative return?
That's exactly how we do it. We treat every decision, every selection as a transaction. So literally we have a table of 12, think of them as positions, 12 $1,000 positions in Cognizant, and we track the performance, versus the market for each one of those. So that the number for Cognizant, for example, I'm going to show a number here in a few minutes for the Manifest 40. Same thing. We're basically tracking the average performance of those 12 positions. Hugh, did you have any comments or observations on any of, there's many of your companies here because you're so stubborn with some of your selections?
Yeah, I'm just, I guess, a little bit surprised that some of the companies haven't done better, like Bank of America. But it's just testament to how different the Great Recession was, and the fact that the recovery is really, really slow.
Well, Bank of America has nearly doubled.
Yeah, I thought it would be significantly higher.
You thought it'd be higher than that?
Again. Yeah, it should be. I mean, it will get there. I mean, it has a lot of things weighing it down, took on a lot of debt.
Mm-hmm.
Things got diluted badly, but it's just taking a while for things to get back on the straight and narrow.
This recovery has been quite protracted and pretty sluggish, so it's taken some time. All right, well, with that, I think we'll press on. Again, you can look up any of the 100, so I'll probably be doing some housekeeping after I make the additions from tonight's session, but it can be some interesting kicking around. I'm going to go ahead and kick off our discussions here tonight, or my selection here tonight, with just a quick look at a screen that we often do. And I'm going to get to my selection of Apple as a result of this chart. And it's a little bit busy, but let me kind of unpack this for you a little bit. I think the market is fairly overvalued, not significantly, not extremely, but some. I mean, you guys have seen our MyPar, which is our median return forecast for most stocks down in that 5, 6, 7% range for quite some time. And the July correction has actually taken that down, or has actually brought the return forecast back up on the average stock to almost 8%. I think it checked in at 7.7% yesterday. That's compared to what it was a few months ago, down in the 5% range. So I think we were, more overvalued than we probably are now. I think that we still could face some corrective moments, that sort of thing. And I think for a group of guys picking some stocks like we do here at the round table, I do think it's important to always accumulate some core stocks also. So for this particular portfolio, what you're looking at is a list of companies where I have isolated the top. I used a quality ranking of a minimum of 95. So you're looking at the top 5 percentile. Anything with a quality ranking of 95 or above. So you're looking at some pretty excellent quality companies. And they also have a fairly elevated return forecasts. Again, the average stock right now is 7 to 8%. So these are up there pretty well. They're ranked from top to bottom by a combination of those two factors. But again, it's kind of fun to take a look at different opinions. I'm going to double down on this with Hugh's selection here in a minute. It takes all types of opinions and thoughts to make a market. So sometimes you'll see a fairly sizable disagreement. Like look down the list of Akamai Technologies, which is a security company, e-commerce company. The consensus of analysts out there likes it quite a bit, but Morningstar hates it. They think it's not fair valued at all. In fact, they think it's 49% overpriced at the present. So you can get a fairly wide difference of opinion. Right next to that, you can see that Standard & Poor's S&P checks in with pretty much a fair value vote on Akamai Technologies at a 98% price to fair value. So again, this is just kind of, we call it a parade of opinions. Again, walking across the top of the chart, you see Cognizant Technology. If Cy was here tonight, he'd probably be adding selection number 13. Value Line likes it. It has a low return forecast of 9.3%. And then the two next columns, price to fair value, that's literally just a comparison by Morningstar and Standard & Poor's of the current price versus what they think the fair value is. So any number less than 100% is potentially on sale. And until it gets extreme, the smaller or lower the number, the better. Morningstar says that Cognizant is slightly on sale. S&P really likes the company at 83%. That means they think it's 17% discounted right now to a fair price. The next column over is just a 1 year. In fact, the final 3 columns to the right is a short-term outlook. I mean, to us, short-term is probably 3 years, but Wall Street tends to look at 1 year as a long-term thing. I'll get off the soapbox. Right now, the analyst consensus looking at a company like Cognizant Technology is looking for a return over the next 52 weeks of about 10%. You can see S&P checks in at 7%, and the last one there is Goldman Sachs. We choose Goldman Sachs because they are so influential. So as I walk down that page, I'm not willing to go into coal. A number of coal companies actually showed up on a number of screens today. Interestingly enough, when I started looking for companies that were trading near their 52-week low, a bunch of integrated oil companies came up, and I didn't have the right one. I was looking at companies like Exxon, and he was going to go with ConocoPhillips here tonight. But a bunch of those showed up, and you can see, for Atwood and the coal company, Alliance Resource Partners, the street, again, as defined by the analyst consensus, really has huge expectations for these companies over the next year. Time will tell. I don't think I'm ready just yet. So kind of walking down the list, I'm looking for somebody that's, a very high quality company, still has a decent return, it's at least not hated by anybody involved. Fossil is attractive. That's a company that Ken and I both selected on the same night a couple of years ago. It's done fairly well for us, but it's faced some challenges. And right smack dab in the middle of the list, you see Apple and Buffalo Wild Wings. In the case of Apple, I mean, we get a consensus return forecast of about 14%, a very high quality rating, excellent quality rating. Value Line likes the company. 7% may not seem like a lot, but the average company is down around 4 to 5%. Morningstar thinks it's on sale by at least 10%, 10 to 12%. Apple really likes, Standard & Poor's really likes Apple at 75%. And then the 1-year outlook, thanks in some respect to the price drop, which has happened over the last couple of weeks. The analyst consensus, the Standard & Poor's outlook, and the Goldman Sachs outlook are all pretty strong for Apple. Again, when I'm looking to protect myself in the clinches, I'll turn to something like an Apple to provide some cover under these conditions. So I'm going to go with Apple. Here's a look at
Mark, before you get off that chart, we have a question from Ann. And Ann, I'm going to unmute you. Go ahead with your question.
Okay, Mark. I've always had a question about this chart that you have.
Cool.
And I'll just go with the Pacific thing tonight. When you look at Apple and you look at Qualcomm, and I know Qualcomm is having some issues right now, why would you pick Apple over Qualcomm when the value line total return for Qualcomm would be 12 as opposed to 7 with Apple? Because the other numbers, they're about the same. And that's my question.
That's a fair question. I wrestled with both. In fact, as I was thinking about what company to bring tonight, Qualcomm was at the top of the list, Apple was like second, and T. Rowe Price was third. And probably the reason with Qualcomm has to do with a little bit of anxiety I'm having. What Ann is referring to is, Qualcomm, these are fairly comparable numbers when it comes to the return forecast and the quality rating between the two companies. Fair enough. I think they're both, in the same, certainly in the same pew when it comes to that sort of thing. But Qualcomm has a very nice expectation from Value Line, whereas Apple's a little bit lower. And again, looking across the spectrum here, I could have just as easily picked Qualcomm here tonight. I'm just a little bit concerned with what's going on in South Korea and the stuff that's come down to Samsung. I'd like to give it a little bit more runtime. There's a relatively high probability that I could bring Qualcomm back next month. So it's really kind of a coin toss at this point. And I point to Apple because of the numbers across the board. It could go either way. Either one of these could have been selected using those metrics. Does that help at all?
I've muted Ann,
okay.
Mark, so why don't you go ahead with your next slide, okay?
Okay. Let's go ahead. Here's a look at Apple. Again, Qualcomm looks good too. If you look back, we picked Qualcomm just a few months ago. Taking a look at Apple again, an exciting growth story. They have kind of plateaued out. That's no surprise. They're playing an awfully big field. You're looking at the business model or visual analysis here. Again, we focus more heavily on the right-hand side of that graph. I think it's fairly easy to make a case for high single-digit, low double-digit growth for a company like Apple. And you can see that the earnings and the price have followed right along also. So we'll come back to that. But again, I would place this in almost up straight and parallel category with the caveat that these guys are in a tough business that can have some cyclicality to it, and they do pretty good over the long term. As we're forming our notions of what might be achievable with respect to profitability, I always like to look at the visual representation of the profitability. The net margin over time really spiked up as they came out with some of their new products back 4 to 5 years ago. I could see this company, literally continuing to maintain 20% profit margins. I don't believe they will continue to shoot up as that trend line suggests there. The analysts all come in that 22 to 24% range, so I'm comfortable with anything in that area. So again, 9 to 10% growth, 20 to 22% margins seem to make sense to me. The third milestone judgment that we use for any company is the PE ratio in the future. And basically coming off that exciting period for Apple back in the middle of the last decade. And again, I almost look at this like a 747 landing, a smooth landing at the airport. Where's this going to come in over the long term? And I think anything assumed in that at a PE ratio of 12, give or take, 2 or so, makes sense to me. I think 12, 13, 14 for a PE ratio makes a lot of sense for a company like Apple. Here's one of our favorite charts that we like to look at. It's our chronicle over time. Again, this is as if you sat the analyst consensus down and did a stock study and looked at the projected annual return, that return forecast over time. And the thing that I like to see here is that it is spiking back up with the plateau in the stock price, and the price has actually come down here recently, giving us a little bit of a buying opportunity as the return forecast has spiked up a little bit here in recent days. And again, you go back and you take a look at periods like back in here when the stock price was languishing and the return forecast was quite strong. Many of the members of our investing community were accumulating this stock. The quality is consistent, hanging in there right at excellent levels, so no problem there. Again, I like to see that return forecast spiking up a little bit along with that flat spot in price. Good long-term investors don't get frustrated with flat spots in price. Here's one of the favorite points I like to make with, again, our community of investors. I refer to as strength in numbers. We put out something called the Manifest 40. Apple is the most widely followed stock by Manifest subscribers. It's been that for several months now, several quarters. We put this out on a quarterly basis, and these are the top 10 stocks followed by our subscribers, again, Apple being number one at this time. What is so cool about this is we've been doing the Manifest 40 now for nearly 10 years. We'll be spending a fair amount of time with this here in the next few months, but nearly 10 years. The interesting thing about Apple is it wasn't among the charter members of the Manifest 40. In other words, there were 40 stocks ahead of Apple back in September 2005. You can see some of the charter members right here, going all the way back to 2005. Well, Apple joined this list back in September 2009. And what is so cool to watch with our community, and this is one of the reasons we do this, is back in this time frame here, people from our community of investors were just loading up on Apple back in this time frame when the stock price spiked down. I believe that's a stock price of down around $12 a share back at this point in time, to the point where it actually joined the list, the Manifest 40, back in September 2009 at a price of $24.67. It is now trading in the $125 range. What is so cool about that is a 26% annualized relative return compared to the market performance. And notice the other one that we talk a lot about around here, Cognizant Technology, checks in at 28. Again, this is that number we were talking about just a few minutes ago, where 2% is good, 5% is great, 10% is out of this world. We'll take a look at how Apple and Cognizant have done for a great number of investors here. So again, and when I'm trying to protect myself in the clinches, these are the type of companies I like to turn to. And it all looks pretty good. So in closing, I take a look at Apple these days. I'm not terribly concerned about their future. They're innovative, and they'll continue to roll out products and improve on products that they currently have. I see a $220 billion company growing at approximately 10%, capable of delivering 20 to 22% net margins, and with a PE ratio that I think is actually pretty reasonable in that 12, 13, or 14 range. I used 14 to give me an approximate return forecast of about 14%. Again, that may not seem like a huge number for a company like this, but again, when you're comparing that against the average stock at 6 to 7%, I think that's a pretty good premium, and it's been good to us so far. I think we've selected it 3 or 4 times already. It's our second largest holding in the tracking portfolio, so I'm gonna basically double down on it again. So with that, I think we'll switch gears to ConocoPhillips. And just to kick things off, I did show some of the numbers from that, those opinions across the the parade of other companies. And again, sometimes when Hugh comes with some of these, they might not necessarily make sense on our stock studies, but that's because he's assuming different things for profitability, perhaps growth. I mean, this is a fairly newly reconstituted company in the last few years. And notice that Morningstar, the analyst consensus, and Standard & Poor's have pretty powerful outlooks for this company right now. So with that, Hugh?
Yeah, and the other thing is the length of time that I plan to hold this thing. I mean, the financial news is bad, but it's in an industry that everyone needs, energy and liquid energy for that matter. It's in the exploration business, which is hot now because demand is going to constantly increase, I think, for the next at least 20, 25 years. Yes, they'll nip into it with solar and other renewables, but hydrocarbons is where it's at. And right now, hydrocarbons is suffering. And the great thing about this industry is that because demand is kind of constant, it grows steadily, but it's constant at any given time, it doesn't really respond to price changes. So people do not change their driving habits really dramatically if oil prices increase. There are some little change, but by and large, airlines have to fly the same routes. People have to commute to work. Gas consumption continues on its regular upward 90 to 93 million barrels per day and climbing steadily year over year. And it will continue to climb as economies grow. Right now, it's out of whack. A lot of production has come online. Things will settle down in Iran and in Libya. We'll have way too much oil. That'll drive people to start buying cars because they'll be able to consume them again in places like China and India, and things will start on the upward ladder again. So we move on to the next slide. What I do every time I want to buy, practically every day, but I don't buy every day, but I'll run a very simple spreadsheet where I will see where companies lie compared to their 52-week low. And right now, ConocoPhillips is within 4.8% of its 52-week low. And it's also at a price that's cheaper than I bought it at in the last number of years, which is good. And so these are the companies that lie kind of up towards the bottom 50%. And I also took a look at their dividend and their dividend yield. And Conoco has a very nice dividend yield, and it has been a very stable, steady dividend and a steady dividend grower for many, many decades. Company changed, as Mark pointed out. It spun off its downstream activities, but we can chat about that later. And then moving on, I added the quality and the par, and you can see that par is low. Now this comes from a number of different sources. It comes from Manifest Investing, but I'm looking to hold this company for a very long period of time, and I do like to buy things when they're at 52-week lows for small companies if they're a multi-year low. And I hope ConocoPhillips is at or close to its multi-year low. It may not be. If it isn't, then I can always buy more. And the next slide just shows that in this case, I don't necessarily select the company at the bottom because for the case of Pain Therapeutics, it's not a quality company. But ConocoPhillips has a high dividend yield. Yes, it has a slower than hoped for growth, but I mistakenly thought I had added this to the Manifest portfolio in the past. I don't believe I have, but I have been adding it pretty steadily into my own. And I give preference to companies that I have added to a portfolio already. I could have bought Caterpillar. It's nice and low, and it's lower, I think, than the prices that I bought it at for this portfolio. But of course, all of the oil companies, you see Chevron is in the mix as well, and BP isn't doing that much better, even though it's within 16% of its 52-week low, and it has a slightly better dividend yield. But for now, at least, I am going to add ConocoPhillips. And if we move along, this is the companies that are, I call it the bottom of the heap, but they're really at the top. They're close to their 52-week high. And Allergan has been on a tear recently, as have many generic companies. Walgreens has just been doing phenomenally. It's not Walgreens Boots Alliance. I think it's Walgreens Boots Alliance. The company is Walgreens, the stores are Walgreens, but now I think they have decided that universally they will pluralize things. So I think I'll have to change that to Walgreens.
I'll have to check our stuff too.
Yeah, but I think that's what they've done. I mean, Walgreens is kind of a strange one. I love the company, by the way. So moving on, I've chosen ConocoPhillips. It's yet another oil company, and it's important to note that about 60 to 66% of our energy needs are met with hydrocarbons, with oil and with natural gas. That's where ConocoPhillips sits. There have been problems with oil prices, but that's driven by just a surge in supply. Back in oil fields, the U.S. is now probably one of the largest oil producers, or close to one of the largest oil producers on the planet, and has 50 to 100 years of, arguably, of oil in reserve in places like North and South Dakota and that back in oil field area, which is wonderful. But they are discovering oil in different places around the planet, and that's good. That's great. That supply will come on, but demand will increase as well as the private enterprise system spreads around the world. People will buy the same things as have been bought in Western countries, and that's evidenced in China and in India, and that will increase. But the problem with oil is that it's difficult to get it out of the ground. At least it can be difficult, and you need to spend a lot of money to set things up to start pumping oil or extracting it from shale. And then you kind of make profit over time. You make a large capital investment and hope that it can pump oil for a decade or more and pay off this capital investment over time. Companies like Conoco have made lots of investment. They're not cash flow positive right now because of the problem with the oil price. And you will see as earnings are reported later this week that I'm sure they will cut back on capital expenditures, maybe shutter projects that they're working on already, which is a response really to the short-term thinking of many investors. And that's what companies will do. BP, Exxon, Chevron, they will all likely do that or announce it this week. But the good thing about Conoco is, despite the fact that it has large capital investment, its current debt to equity ratio is low compared to peers, although its profit margin isn't where it really needs to be. So we skip on to the next slide. I've just chosen a few points to highlight here. The industry itself is interesting to analyze because it's really divided into three big segments. There's the exploration side, there's the distribution side, and Warren Buffett has benefited from that by buying into the train industry, into the transportation industry for oil and related products. And then there's the downstream, which would include gas stations, the refineries to make the gas from oil, etc. And at one point, ConocoPhillips, as were many companies, they were totally integrated, but they split off the downstream activities into Phillips 66. That happened in 2012, so those of you who owned it ended up with shares of that company. And ConocoPhillips sits on the exploration and distribution side. And its products include crude oil, bitumen, natural gas, and liquids. Most of it is liquid hydrocarbons. And it produces 1.5 to 1.6 million barrels a day, which is not a lot. Globally, the consumption at the moment is about 92 to 93 million barrels a day. The U.S. consumes, I think, 25% of that. So we skip on. One of the big drivers for liquid hydrocarbon is car sales. And this is very interesting because these numbers go up to 2010 with an estimate to 2011. And you can argue how good are these people about predictions. But the fact of the matter is, look what is happening in China, where now you're up on 15 to 18 to 20 million cars. If it goes down the same path as the U.S., this number will quadruple and maybe quadruple one more time. And there's no reason to expect that the behavior in China should be any different, or in India, or Russia, or Brazil should be any different than has been seen in Europe, North America, and Australia, or any of the other developed countries. So if you move along to the next slide, and by the way, you can get a lot of these data from, you can see the source down on the bottom right. It's the EIA, the Energy Information Agency. It's EIA.gov. If you're a numbers nut, you will love this site. And in fact, there are many websites that the federal government runs. If your numbers nut, you will love it. You can get individual prices from city pairs and the airline industry if you're interested. See how much people pay in first class. Now we'll just focus on energy. And you can see here that these numbers came from about 2012, and they are predicting into the future. They're predicting increases in liquid hydrocarbons and natural gases. Coal will continue to grow, and so will renewables. And you look at this and say, you know, it's not a huge growth, but it is a steady growth. And when you have inelasticity, when supply and demand are critically locked together, so if there's any imbalance, it has an immediate and dramatic impact on price. A slow increase like this is fine. And you wonder, how good are they at predicting? And I found a slide from the EIA, which I present next, that goes back to 1999, when they were predicting what the daily consumption of oil would be through 2020. And I think this slide is quite remarkable. Today, they're predicting that it should be about 101 million barrels a day or something like that. Now, it's not as much as that. It's 93, 94, but that's still quite accurate when you're trying to predict, in this case, 16 years into the future. This industry, interestingly, follows demographics, and it is quite predictable. And the fact of the matter is that oil consumption will continue to grow, and companies like ConocoPhillips, for that matter, Exxon or any of the others, they will benefit. We'll have a shortage one more time and again, and it will repeat in cycles as it always does, and the stock price will jump up dramatically. And that's when the analysts will decide that it's a good time to buy, when it's close to a multi-year high and a low dividend yield. I prefer to have already owned it at that point and I bought it at a much lower price. So we skip along. This is a highlight from a fact sheet produced by the company, but you can see here they obviously put their best foot forward, and the thing that often jumps out to investors is the increase in the quarterly dividend, which has been quite good, but it does have a strong balance sheet. It has a phenomenal asset base. It's drilling and discovering all across the planet, and it claims to have a disciplined investment strategy, but we will see later this week what it does when it announces, I'm sure, that it will be cutting back in production. Probably at the wrong time, but that's the way life is. And it is big in Libya, and Libya, Nigeria, not so much Brazil, Venezuela for sure, are countries where there's an element of instability, and these companies, Nigeria I mentioned, have oil. They have extremely good reserves of oil, Venezuela particularly, but they have a difficult time getting it to market. And right now, these countries are in the doldrums. They will improve. More oil will come online. Iran will likely come online in a year or two now that there's an agreement with that country on nuclear weapons. So we skip along to the next slide. You can definitely see where it has its global presence. In some of the major areas for producing, in North America, the new fields, in Azerbaijan, where there is an immense amount of discovery going on, and Indonesia/Malaysia. We move to the next slide. We can see where the average daily production comes from in Europe, in Asia Pacific, other regions internationally, and in Alaska, where it's a major producer of liquid hydrocarbon. So moving along, this was from 2004, by the way. It has a revenue shortfall fiscal year 2014 versus 2013, and that's actually driven by pricing. Pricing in the oil industry, as we all know, has been beneficial to consumers, horrible for companies like ConocoPhillips and its peers in the industry. And as a result, share prices have plummeted, and I just want to take advantage of that as long as it will go. The company has continued to grow its dividend, and it can afford to do that. It has a strong balance sheet. And the fact is that low oil prices don't last forever, and if they were to last forever, companies would readjust, the balance sheet would readjust, and they'd be back off to the races again as they shut down all of their discovery efforts, as they did 10 years ago, and push their share price up to another high. And you skip along. So shale production in the U.S., interestingly, is now flat. And this is one of the reasons that that is the increase has stopped. It's nice and level. So a lot of the projects that were pumping the oil out of the ground and natural gas, they've slowed down, a natural response. ConocoPhillips has a major presence in one of the biggest fields. In fact, two of them. The backhand one is one that most people hear about. But the one thing I want to keep stressing again is that the supply-demand issue in this industry is really interesting. It's very inelastic. So that if things get out of whack and demand is greater than supply, or supply is greater than demand, you see an immediate, by immediate I say within a matter of weeks, change in price of oil that consumers use in terms of gasoline, the downstream product. These things happen quite dramatically. And again, we don't change our behavior. Our demand is pretty steady. And the problem often comes with supply. And when there's oversupply, we're the beneficiaries of that. When there are problems, and you can see that happens in California, particularly when they're changing the fuel mix and refineries and maybe shut things down for a week or two, prices can move. Right now we're in a bit of a lull, but it will recover. And that's one of the reasons that I like these companies, and I select ConocoPhillips because it's closest to its 52-week low compared to some of the others that I've been looking at.
Very cool. Thank you.
So I'll hand it back to you.
Yeah, I attended a presentation by an oil analyst not long ago, and he pointed out, and to make this point about the price being um, so movable. If you go back to the Olympics in China back in the 2008 timeframe, uh, they can actually show that China stockpiling and warehousing oil just to prepare for that Olympics actually caused a demand or a supply disruption that you could actually chart on prices. So I mean, that's when you think about the long-term picture of the companies that you just presented, pretty staggering.
Yeah.
So,
And I do suggest EIA.gov if you're interested in numbers in the oil industry. It's an interesting website.
well, there's some great
Paying
stuff
for it with
there.
tax dollars, so log on and check it out.
All right, so we'll turn from computer equipment and hydrocarbons to a different kind of fuel, the red hot Buffalo Wild Wings. Take it
Well,
away,
thanks,
Ken.
Mark. Can you hear me okay?
Yep, you're doing fine.
Great. I just got tired of picking cyclical stocks, and I decided to go back to up, straight, and parallel. And this graph shows you that you can't get any more up, straight, and parallel than this graph over the last 9 years for Buffalo Wild Wings.
Yeah, that's
I've read a lot of mottos for company, a lot of mission statements for companies, and if you could click, Mark. When I got to Buffalo Wild Wings and started studying it, I found out that I could memorize Buffalo Wild Wings' motto. Its motto is beer, wings, and sports. And that's the motto statement, the mission statement that this company operates on. Beer, wings, and sports. So it certainly has a different thrust than ConocoPhillips or that Apple Computer might have. But it meets a need in the population, so I started to learn a little bit about the company. I've actually owned Buffalo Wild Wings for many years. It was brought to a model club meeting as an IPO, and that had to be a number of years ago, and we broke a lot of rules because folks had gone to visit B-dubs, as they're called, and we broke a lot of rules and put some money into it. It just so happens that Michigan has the most Buffalo Wild Wings locations of any state in the union. If you'll click again, Mark. Let's dispel some myths about Buffalo Wild Wings. First of all, there's that core brand focus. Wings, oh, I had it in the wrong order. It's wings, beer, and sports, okay? A pretty medium-sized company, growing very, very quickly. And right now, about evenly split, maybe 60-40 as far as franchised and company-owned restaurants, maybe 55-45 even. And that's one of the myths that was dispelled almost immediately as I started to do research, because my experience around Michigan here with all the Buffalo Wild Wings that existed were that they were all almost uniformly franchised restaurants, and I just had assumed that franchised idea was what ran the company. But actually, a little bit less than half of the restaurants are company owned. If you'll give me a click again, Mark. From 2013 to 2014, there was some phenomenal growth going on in these restaurants. That YOY stands for year over year, and you can see that the company-owned restaurants and the franchised-owned restaurants together grew 9%. The average unit volumes, that means the amount of money that each one of the restaurants is generating, grew, in my estimation, a phenomenal 7%. That's same-store sales growing 7%, and revenue growing about 20%. Notice net earnings growing 32% year over year. One more click, Mark. And we go from 2014 quarter one to 2015 quarter one, and we even get a higher rates year over year, especially when you focus, in my mind, on these same store sales. How a restaurant chain can continue over a long period of time to grow same store sales above 5% is something that I find amazing. And also keeping their revenue moving in an upward direction. One more click, Mark. Here's where the restaurants are. Notice a few of them in Canada. There's a couple of East Coast states, those small states up there in New England, where you won't find any Buffalo Wild Wings. My brother is visiting here from the Boston area for the last week and a half or so, and he had never even heard of a Buffalo Wild Wings restaurant anywhere near him. Well, that's because there aren't any in Massachusetts. But like I said, there's 55 of them, and at one point that was the most Buffalo Wild Wings in any state. I noticed that Ohio and Illinois have surpassed that 55 that Michigan has right there. Click again, Mark. Another myth that I dispelled as I was doing some of my reading about Buffalo Wild Wings is that they made most of their money after the sun went down. It was late night kind of stuff, or it was Saturday afternoon kind of stuff. And in fact, they make half of their revenue at dinner. And that it was a complete surprise to me. Buffalo Wild Wings never appeared to me, at least, to be a place where people would go for dinner. And yet, for a particular demographic, dinner is where they spend a lot of their money in this restaurant. Notice that about 2/3 is just based on this wings and beer. 2/3 of their revenues are coming from boneless or traditional wings, and then the beer and the alcoholic beverages. All the other things that they sell in their restaurant represents less than half of the revenue that comes into the restaurant. Click again, Mark. They're expanding. We're moving into Mexico, some of the Middle East, Saudi Arabia, the UAE, and we're moving into the Philippines. So the company has some ambitions to go international, but right now it's pretty compact in the United States and a little bit in Canada, which means it doesn't have any major problems with currency as it tries to bring currency across the borders. The strong dollar is not hurting it very much at the present time, at least. Another click. They also are experimenting with some other models to increase the business. They've created a Rusty Taco brand and a Pizza Rev brand. One more click. Here's what a Rusty Taco looks like. They're playing up the whole taco can be anything today, including a lot of Asian food in tacos today. And they're playing up the fresh idea. So we're looking for almost anything that you could wrap in a tortilla with very, very fresh ingredients. And the Pizza Rev, think of Subway sandwiches crossed with a traditional pizza restaurant. So you have somebody standing behind a service bar and you're telling them what you want to place on the pizza that they are going to make in front of your eyes and then throw into these really large ovens and have on your table within 8 or 10 minutes. Pizza Rev. Maybe you're lucky enough to be around either one of these concept restaurants, but they are rolling these out slowly but surely. And if they're successful, if they're even remotely as successful as Buffalo Wild Wings, then we stand to see quite a few of them in the next couple of years. One more click again, Mark. Here's some of the information from Value Line. You can see that Value Line is predicting earnings growth of about 17%, revenue growth of about 15.5%. And usually, Mark and I have noticed that the low total return figure on a Value Line sheet, Mark just circled it right there, is pretty indicative of what you get when you do a fairly conservative stock selection guide. Well, I drive my wife crazy by keeping old issues of Value Line. I probably have 2 stacks about 4 foot high in each of them. And I got really curious. So I went back for the last 5 or 6 years in Buffalo Wild Wings, and I checked out. It only appears once every quarter in a Value Line, of course. And I checked out low total return versus high total return. And I think Buffalo Wild Wings is one of these companies that is the exception to prove the rule. I found that the growth in the company's stock price was much more typical of numbers up at the high side on the value line sheet than it was on the low side of the value line sheet. So if I'm going to go forward, I think that I might be pegging my anticipated growth for price appreciation, maybe at the 12, 13, 14% number rather than aiming it at that low end at 4 or 5%. This company seems to have a history of beating the market, of exceeding expectations on a fairly regular basis. Another click, please, Mark. Here's the graph, and you saw that at the beginning. Mark had captured this same graph to introduce the company. All I can say is I'll have 3 words to match BW's motto, and I'll use the 3 words up, straight, and parallel. Click again, Mark. I love the quality analysis. It says everything that it's supposed to say. I'm looking at margins that have stayed amazingly consistent over a fairly long period of time. I mean, those margins between 8.5 and maybe 9%, they've been there since 2006, since before the Great Recession. You can't see the Great Recession on their graphs or in their profit margins. Return on equity, we teach beginners that 15 is a great number and that anything over 20 is an outstanding return on equity number. And this number is clean because the company carries 0 debt. You can muddle up that return on equity number a little bit if you carry a fair amount of debt, but this is a clean ROE because of the 0 debt. And here I am getting a par value on my SSG that is matching the high expected return from Value Line 15. Now, I think I've done a fairly conservative SSG. I deliberately omitted my judgments. I find that too many people take my SSG and copy my judgments in and say that those are the right answers. And I don't think there are right answers. The answers have to fit your judgment. So I urge you to do your own stock study and see where your SSG ends up. Here's the Eagle. One more click, Mark. That comes off of Manifest Investing, and since it's within 1.5 points of where my par value comes from on my SSG, I have some good feelings about my SSG. I'm pretty confident about it, and I think that I wouldn't change too many different things on this Eagle. I might make some minor tweaks, and I might raise or lower that par value, 0.5% or 1%. But when I can do a classic SSG and then look at Mark's Eagle and be within 10% one way or the other, even 20% one way or the other, I have some great confidence. Mark, is it possible to go to the Manifest site and show the graph at the bottom of Buffalo Wild Wings page?
Sure, we can do that. One of the things I wanted to point out is, you're right about it being the exception. I think Value Line tends to struggle from time to time with relatively high growth, relatively high PE companies. And if you really look back over the history, I think Value Line probably comes up short on the PE projections.
They do, Mark. They uniformly, they were very reluctant to project PEs above 30 for this company, and the PEs have routinely been in the high 20s, low to mid 30s or higher. There's 2 things on this graph that I want to point out. One is that I really, really watch this blue line very carefully, and it seems to have faded off right there, but it's going across right where Mark is pushing his
I'll get
pointer.
Kurt to fix the legend here.
Okay. But I'm looking for a company always when I'm buying a stock. I'm looking for a company with a great consistency in its quality rating. And this quality rating for this company has stayed somewhere between 98 and 100 for a long, long while. The other thing that Mark mentioned early on when Manifest first became a site and we first started talking about different things to look for, he mentioned that you should really take that par value that's coming from Manifest Investing, and you should kind of compare it to historically high par values, because some companies never reach a really, really high par. And if they come up with something that's historically high, that's probably a great opportunity for a purchase. And I'm looking here and I'm saying to myself, I'm seeing par values in Buffalo Wild Wings that I have not seen since 2011, since way back in maybe July or August of 2011. And I'm thinking to myself, this might be just a really great opportunity to purchase this stock. Now, I was a little bit taken aback to see some of our favorite standard sources kind of saying that the company is fairly valued or even a little bit overvalued. But I'm pretty confident in the methods we use to project going forward. I'm pretty confident in my SSG skills and abilities. And when they're both telling me that the par is 14 or 15%, and when it hasn't had a par that high for a long while, I'm thinking it's time to add to my holdings in Buffalo Wild Wings. I will tell you a secret. The club that owns a really nice position in Buffalo Wild Wings has been buying it on a fairly regular basis for the last 2 years. They've continued to buy it since somewhere in the middle of 2013, and they've been buying it through the ups and the dips and everything else. I will disclose that I have a personal holding in this company as well, with a pretty nice basis attached to it. So I'm happy to add some more to my personal portfolio. And I was surprised to see that we had never added it to the roundtable portfolio. So here it is. Let's take a $1,000 position in Buffalo Wild Wings.
Well, thanks, Ken. And I think we can go ahead with the poll if you're ready.
Okay.
And after the poll, go ahead.
We have a couple of questions. Ann says, do you think the PE for Buffalo Wild Wings is high or just about normal? I find it to be relatively normal. Susan is saying, is my value line current? And Susan, I think that the value line I was using was extremely current. And Lorraine says, what's an EAGLE? Mark, can you tell us exactly what the acronym EAGLE stands for?
Well, it's a little bit hokey, but it stands for Equity Analysis Guide to Long-Term Expectations. So Equity Analysis Guide, it's just a way of acknowledging, it literally comes from the conclusion that we reached years ago that a stock selection guide is not just a selection guide. It's a tool for continuous analysis. And that's our reminder is just it's an equity analysis guide.
Yeah, Susan also wants to know, am I concerned that the last 2 quarters were negative? And Susan, I don't know how to say this, but I don't get concerned about quarterly numbers too much. I think there's way too much emphasis placed on quarter-to-quarter numbers for companies. I know that Buffalo Wild Wings is relatively sensitive to chicken prices. Have you gone to a store recently and priced wings versus things like thighs and legs and everything? You'll find that these bony things that you used to be able to buy for nothing, you'll find that they're one of the most expensive cuts of the chicken right now. So no, it doesn't particularly bother me. A lot of you are bothered, and if you're bothered by some of the things you're asking questions about, then my advice is don't invest in this particular company. But for me, I have a story that I'm pretty happy with, and numbers that I was pretty happy with. So let's put this poll out there. Maybe Apple will win tonight, Mark. What do you think, huh? All right.
No, I think the hydrocarbons probably a pretty good shot.
Okay, here we go. We're going to launch the poll, all right? All you have to do, folks, is take your mouse and click on the stock you think you would like to buy, and we'll see which stock wins the race. I'd like to get about 85% of you voting if I could, so just take the time to click one of them. It's we're not going to check to see what you voted on. I don't think we can check to see that.
Oh, I can.
Oh, there we go. You can. Mark can. So we are up to 90%. Thank you for letting me beat Mark once again. But Mark was right. The Conoco did come out on top. Let me try to share the results. There's awesome. The ConocoPhillips. Oh, somebody snuck in here with another vote. Now Apple came out and nudged me out to third place here. So.
That's justice.
I don't think you've ever been in third place, and I know I've never been in first place, so I'm a bit worried.
My mom must have just joined the group.
It reaches a crescendo, Hugh. Better watch it now. Okay, it's all downhill from now on. So we will add two positions in ConocoPhillips, $2,000. One of them labeled McManus, and one of them labeled Audience. Okay. So let me see if I can get us back to the regular. There we go. So our next round table has been determined by now, folks. Our August round table is going to be on September 1st. The calendar is kind of strange, and Labor Day doesn't occur until the 7th. It's as late as it possibly can be. So we're going to run the August round table on September 1st, and then we're going to run the September round table on, and I'm double checking the date, Mark, on September 29th, okay? Mark and I will both be at the Chicago Investors Conference. It's a great conference, be a lot of folks there. And right now, Mark and I are both planning to be at the Seattle Puget Sound Conference in November as well. Contact the Chicagoland chapters for information. Hugh, are you going to be in Seattle as well? Hello?
Yep, I will be there.
Oh, great. So we'll have
Can you hear
Hugh.
me? Yes,
we can hear you just fine. Yeah, we'll have Hugh and Mark and myself in Seattle. And the Chicago conference, contact the Chicagoland chapter for information about their conference. That one's coming up pretty quick. And the Puget Sound chapter, I'm sure on their website you can get a lot of information about their November conference. That's coming up in a few months here.
We'll have some more information on the events link at the bottom of the page there too, on all those events pretty soon.
Well, I'm looking at the question box right now. I'd like to make sure that we get all of the questions that were asked. So let's see. Ann says that's the most even voting she's ever seen. Ann, that probably means we either chose 3 really bad stocks or 3 really good stocks. So one or the other here, okay? Other than that, I think we've covered, we have a couple of comments, but for the most part, we've covered all the questions. So I'd like to thank Mark and Hugh for being here this evening. And I hope we see a lot of you online on September 1st for the next session of the Mid-Michigan Roundtable. Thank you all very much.
Bye.
Thanks, everybody.